Friends, thank you for being here today. As we sit here in the quiet interlude between Christmas and the New Year, looking at the stillness of the markets and the flatness of the charts, it is easy to be lulled into a sense of security. The volatility of the year seems to have vanished. The screaming headlines have paused. You might be checking your portfolio, seeing silver hovering around $72, and thinking that the war is over for the year. But I am compelled to share a different perspective with you, one that your broker is unlikely to mention, and the cable news networks are too distracted to cover. What if I told you that the silence you are witnessing right now is not the peace of a stable market, but the terrifying quiet of a shoreline just before a tsunami hits? And asking a step further, what if the very mechanisms designed to keep financial markets stable have been turned off for the holidays, leaving the door wide open for the most violent upward repricing of silver we have seen in 45 years? We are currently standing in the eye of a hurricane. Tomorrow morning, the eye wall hits. We are entering a specific, dangerous, yet potentially lucrative window of time known to professional traders as Ghost Week. This period, running from December 26th to January 2nd, is not merely a holiday break. It is a structural anomaly in the global financial system. When combined with the breaking geopolitical news out of Venezuela, the Federal Reserve's capitulation on inflation, and a historic drain on physical silver vaults, we are looking at a perfect storm that targets a massive gap up in prices, potentially an 8 jump by the time the world returns to work in January. To understand why this is happening and how to protect your retirement during this transition, we must look beneath the surface of the price charts and understand the mechanics of the danger zone we are entering. If you have been investing for decades, you know that markets usually operate with a certain rhythm. There are buyers and sellers, checks and balances, but the week between Christmas and New Year's Day breaks these rules. In the brutal, leveraged world of futures trading, time is not linear during this week. We need to start by discussing the skeleton crew phenomenon. Think about who actually moves the markets on a typical Tuesday in October. It is the senior risk managers at the major banks. It is the head traders at the world's largest hedge funds. It is the sophisticated algorithmic desks in London and Hong Kong. These are the adults in the room, people with decades of experience and, crucially, the authority to deploy billions of dollars of capital to stabilize prices if things get too volatile. But right now, those people are gone. They are in Aspen skiing. They are in St. Bart's on yachts. They are with their families. They have turned off their terminals, flattened their books to secure their annual bonuses, and handed the keys to the castle to the skeleton crew. The skeleton crew is comprised of junior traders, interns, and automated maintenance algorithms running on low power mode. Their instructions from their bosses were simple: don't do anything stupid and just keep the lights on until we get back in January. Consequently, the volume, the amount of money flowing through the veins of the market, drops by 70% to 90%. This creates the most dangerous phenomenon in finance, the liquidity vacuum. To help you visualize why this liquidity vacuum is either a danger to your wealth or a massive opportunity, I want you to imagine the silver market as a frozen lake. On a normal trading day, the ice is 10 feet thick. You can drive a truck over it. If a massive sell order comes in, the ice holds. The price might dip 10 cents, but there are thousands of limit orders waiting to buy. These orders act as a buffer, a wall that absorbs the shock. During Ghost Week, however, the ice melts. It becomes paper thin, because the senior traders and their massive liquidity buffers are gone. Those thousands of limit orders that usually cushion the market are removed from the order book. The walls disappear. So now we face a market with zero depth. If a large order hits the market tomorrow, perhaps a sovereign wealth fund panic buying because of war news, or an industrial user needing metal for January delivery, that order will not find a seller at the current price of $72.10. It won't find a seller at $72.50. It might have to jump all the way to $75 or $80 just to find the first willing seller. In trading terms, we call this slippage or an air pocket. The price does not tick up gradually. It teleports. It gaps. And because the sellers are on vacation, there is nobody standing in the way to stop it. This is why Ghost Week is not a time of peace. It is a time of extreme fragility where one spark can blow the roof off the building. Now, history confirms this danger when we look back at the ghosts of Christmas past. Skeptics often say, nothing happens during the holidays. But the charts tell a different story. Look back to Christmas 2010. Silver was trading quietly around $29. Everyone went on holiday. But in the thin volume of Ghost Week, the price drifted higher because there were no sellers to suppress it. By the first week of January 2011, silver had ripped violently upward, igniting the legendary run that took us to $50 by April. Ghost Week was the launchpad. Similarly, look at Christmas 2020. The narrative of the silver squeeze began bubbling up in online forums during the holiday dead zone. By late January, we were seeing massive gaps on Sunday opens. However, 2026 is not 2010. In 2010, the world was relatively stable and the vaults were full. Today we have a proxy war, a surrendered Federal Reserve, and empty vaults. The potential energy stored in this market is higher than it has ever been. We are sitting on a coiled spring. A liquidity vacuum is like a room full of gasoline fumes. It is dangerous, but it needs a spark to explode. And right now, we have three distinct catalysts converging at once. The first catalyst is the geopolitical spark coming out of Venezuela. While most Americans were unwrapping presents, a significant geopolitical escalation occurred in the Caribbean that has largely been ignored by the mainstream media. Reports indicate a new escalation in the blockade of Venezuela involving the U.S. Navy. Crucially, this is no longer just about sanctions on a rogue nation. The U.S. Coast Guard and Navy have reportedly intercepted tankers, specifically the Bella 1 and the Centuries, that are linked to nuclear powers. The Centuries is owned by a Hong Kong-based company. By forcibly boarding a Chinese-linked vessel in international waters to enforce an oil blockade, we are witnessing a direct provocation between superpowers in the Western Hemisphere. Why does a boat in the Caribbean matter for your portfolio? Because silver is a war metal. When navies start blocking shipping lanes, the algorithms that run global macro funds have a specific instruction: sell risk, buy havens. Usually, in times of geopolitical stress, money flows into the US dollar. But look at the dollar index, DXY. It is trading at a 12-week low, down nearly 10% for the year. The world is hesitating to trust the dollar as a safe haven because the dollar is the very weapon being used in the blockade. Therefore, the fear capital has nowhere to go but gold and silver. If the war trade is the left hook, the knockout punch, our second catalyst, comes from the Federal Reserve. Just before the holiday, we witnessed a quiet surrender. Federal Reserve officials signaled that the market should expect rate cuts in 2026, despite the fact that inflation is currently stuck at 2.7%, well above their 2.0% target. Think about the logic of that decision. Inflation is high, yet they are cutting rates. This is an admission that they can no longer fight inflation. They are admitting that the national debt, now over $36 trillion, is so high that they must cut rates to keep the government solvent, even if it means letting inflation run hot. This is the most bullish signal for silver possible. Silver thrives in an environment of negative real rates. If inflation is 3% and your bank pays you 3%, you're breaking even. But if inflation is 3%, or realistically 8 to 10% if you look at actual costs, and the Fed cuts rates, you're guaranteed to lose purchasing power by holding cash. The smart money knows this. They are exiting the dollar before the new year starts, ensuring that when the markets reopen fully, the rotation into hard assets will be violent. Finally, and perhaps most critically, we must discuss the third catalyst, the physical reality of the vault drain. You can print dollars, you can print rate cuts, but you cannot print silver. On December 23rd, just 48 hours before Christmas, something terrifying happened in the vaults of New York. The official CME silver stock report showed that the Asahi refining vault lost over 1.4 million ounces of silver in a single day. In total, across all vaults including JP Morgan and CNT, over 2.2 million ounces of liquidity evaporated in 24 hours. This is the definition of a cornered market. Usually, when an asset hits an all-time high, like silver at $71, inventory increases because people sell to take profits. But right now, the opposite is happening. Price is at a record high, yet inventory is leaving at record speed. This proves that the entities taking this metal, likely sovereign wealth funds and battery manufacturers, do not care about the price. They care about possession. They raided the vaults before the holiday because they knew liquidity would dry up. This creates a hard floor under the market. Skeptics ask, what if silver crashes to $60 next week? That is mathematically unlikely. The price of silver in Shanghai is trading roughly $5 higher than in New York. If the New York price drops, arbitrage bots will instantly buy the cheap New York silver to sell it in Shanghai. That arbitrage magnet acts as a safety net. And because the vaults are empty, that net is tighter than ever. I would love to hear your perspective on this physical shortage. Do you believe the big banks still have hidden stockpiles to suppress the price for another year? Or does this vault drain truly signal the end of the manipulation game? Please leave your thoughts in the comments below. I read every single one to understand the sentiment on the ground. Looking beyond this week, as we transition from 2025 to 2026, we are moving from the tutorial level to the boss level. 2025 was the year we broke the ceilings of $30 and $50. 2026 is the year the inventory runs out completely. We are seeing confirmation of this stress in the lease rates. According to recent analysis, while gold lease rates have turned negative, indicating plenty of gold is available for borrowing, silver lease rates are rising. This divergence is critical. It means that despite the high price, there is a structural shortage of silver available for industrial delivery. We are in a rolling squeeze. a chronic supply deficit that will cause periodic, violent price spikes. Furthermore, we must look at the broader asset landscape. While silver targets this massive gap up, other assets tell a story of rotation. The S&P 500 is currently floating near the top of its channel, with limited upside remaining. The smart money is looking for the next undervalued asset. Surprisingly, the sleeper asset of 2026 may be oil. Adjusted for inflation, oil is historically cheap compared to gold and silver. Just as silver is catching up to gold, oil may be the catch-up trade of the coming year, which would further fuel the inflationary fire. Before we discuss your specific action plan, I must warn you about a psychological trap that has destroyed more wealth than any market crash: the illusion of the overbought signal. Friends, many of you have spent years learning to read the markets. You have been taught that when a chart goes vertical, when the relative strength index RSI hits 85, and when everyone is bullish, you should sell. In a normal market, that is excellent advice. It protects you from buying the top. But I'm here to tell you that in a currency collapse or supply squeeze, which is what we are experiencing now, those indicators are not just wrong, they are a trap. If you look at history, specifically the legendary bull runs of the past, you will see why selling now based on overbought signals is a mistake. In 1980, silver entered overbought territory when it hit $15. If you had followed the textbook and sold there, you would have patted yourself on the back for a few days, and then watched in horror as the price tripled to $50 in the next few months. It stayed overbought for 5 consecutive months. Similarly, in 2011, silver entered overbought territory at $28. It didn't stop until it hit 49. In a parabolic move, an RSI of 85 or 90 does not mean sell. It means the trend is violent. It means the market has entered a phase of mania where the price is being driven by fear of missing out, FOMO, and physical desperation, not by rational valuation models. If you short this market or sell your position because of an indicator you learned in a generic investing tutorial, you are likely to be run over by a steamroller. The market can stay irrational longer than you can stay solvent. And right now, the market is not just irrational, it is structurally broken. We also need to talk about the robots, because they have changed their minds. For the last 15 years, 80% of the volume on the COMEX has been driven by high-frequency trading, HFT, algorithms. These bots were programmed with a simple instruction: if silver hits resistance, short it. They made billions fading the rallies, knocking the price down every time it raised its head. But tomorrow morning, when the Ghost Week market opens, those algorithms are running a different code. We are now in what is technically known as blue sky territory or price discovery mode. There is no resistance above us. There are no bag holders from 10 years ago waiting to sell to get their money back. Because of this, the algorithms have activated their breakout module. The logic is simple. If price is at an all-time high and volatility is expanding, initiate maximum long positions. The robots are no longer fighting the trend, they are chasing it. And you must understand that a robot does not care if $80 silver feels expensive. A robot does not have a memory of silver being $20. It only knows data, and the data says buy. When you combine panicked human buying with robots that are programmed to chase momentum, you get a feedback loop that defies gravity. Finally, I want to reassure you about the safety net beneath us, because I know the fear of a crash is real for anyone living on a fixed income. You might be asking, what if the war in Venezuela de-escalates tomorrow? What if the banks try one last smash? That is a valid fear. But you must look at the arbitrage. Right now, silver in Shanghai is trading at roughly $77, while in New York, it is $72. That $5 gap is effectively a bungee cord. If the price in New York drops to $65, that spread becomes $12. Do you know what happens then? It becomes free money. Every arbitrage bot, every bank, and every trader on earth will instantly buy the New York contract to sell it against the Shanghai price. This is a risk-free trade. This arbitrage magnet acts like a concrete floor. It catches the price. And because the inventory at Asahi and other vaults has been drained, that safety net is getting tighter and tighter. So even if we get a flash crash during Ghost Week, it is mathematically impossible for it to be sustained. The physical demand from the East is simply too strong to allow the paper price in the West to collapse. So what does this mean for you? And how do you navigate a week that promises both massive gains and terrifying volatility? If you're over the age of 60, your priority is preservation, not gambling. The volatility next week will be extreme. The market will stop behaving rationally. It could whip down $4 to liquidate stop losses, and then whip up $8 in the same hour. The first and most important rule is simply this: avoid leverage at all costs. I cannot stress this enough. Do not use leverage next week. If you are trading futures or buying short-dated options, you are gambling. In a liquidity vacuum, we see Widowmaker wicks, moments where a price teleports down to an irrational number for 1 second before snapping back. If you are leveraged, that 1 second will wipe out your account. You will be liquidated at the bottom, only to watch helplessly as the price recovers and goes to the moon without you. This is a week for holding, not for scalping. Second, you must learn to ignore the paper price and watch the premiums. Next week, you might turn on the TV and see the spot price of silver flashing red. Maybe it drops to $68 on thin volume. Do not panic. Look at the premiums. In a liquidity crunch, the paper price disconnects from reality. While the screen says price is down, the online dealers who know about the vault drain might actually raise their prices for physical coins. If you see a flash crash in the paper market, treat it as a gift. It is likely the last chance to acquire metal before the January repricing. Third, you need to know exactly when to act by watching for the green light. Ghost Week is deceptive. The moves that happen between now and New Year's Eve are often noise driven by bots. The true signal comes on Friday, January 2nd, 2026. This is when the institutions return. In conclusion, friends, the era of easy, predictable markets is ending. We are entering a period of scarcity, conflict, and monetary debasement. The 1.4 million ounces that left the vault this week are not coming back. The tension in Venezuela is not vanishing overnight, and the Federal Reserve is not going to suddenly find a way to pay off $36 trillion in debt without printing money. Ghost Week is the transition period. It is the deep breath before the plunge. The volatility next week might be scary. It might be violent. But if you keep your leverage low, if you keep your eyes on the fundamentals, and if you remember that the smart money is securing physical metal at any cost, then you have nothing to fear. If you found value in this deep dive analysis, please hit the like button and subscribe to the channel right now. It helps us spread this critical warning to more investors before the window closes. The paper silver game is ending. The real silver era is beginning. Watch the news, ignore the noise, and get ready for January.